Hello and a warm welcome to Talking Stocks. I'm Gugulethu Cele. In studio with me is Peter Armitage and Sean Ashton, both from Anchor Capital. Now today we're talking the Lewis Group, a leading credit retailer of household furniture and electrical appliances which are sold through their trading brands Lewis, Best Electric, My Home and Bears. The company has been listed in the general retailer sector on the JSE since 2004. This is a particular company that I think a lot of South Africans will be familiar with, especially given its background. But just a quick recap of the company and its operations. Furniture retail, I take it, and electrical appliances?
So the best way to think about Lewis really is that it's a credit business which utilizes the sale of furniture as a conduit to get those credit loans out into the market. I think that as a financing house, that's where most of their money is made. If you think about this business, they're earning about a 15% return on equity, but we think that without the fairly high cost of credit that they offer, which is bundled together with the sale of that furniture, the standalone retail stores don't do that well.
And I take it that's a concern because it's sold at higher purchase and in particular to the lower LSM group across South Africa, right? Which can't necessarily afford it and have been falling into some kind of issue. So are you still worried about that, especially looking at the local climate where
I think it's certainly a concern, and I think the bigger concern for us is that you've got new competition from a loan granting perspective that certainly has been around for a while, but as the market continues to formalize with the likes of Capitec, their credit offering is substantially cheaper than that of a Lewis as an example. If you look at Lewis, they earn about 58 Rand for every 100 Rands worth of loan that gets disbursed. So when you take into account the interest on the debt that they charge, together with initiation fees, delivery charges, credit life insurance is a good example, they're making about 58 Rand for every 100 Rand of loans. Now the comparable figure for a Capitec would be about 38 Rand, so 20 Rands less. And we think that increasingly over time, the forces of competition and potentially regulation as it pertains to credit life will push down the types of yields that Lewis is able to achieve.
And I take it also has received quite a lot of bad press from the credit life in particular, regulatory environment, so things not looking too good for this particular company.
Sure, what's seen the share price come off by probably about 40% was driven by a guy called Dave Willem, who's hugely respected. He was financial director of African Bank, and he did an analysis of Lewis, how it operated, the returns and its accounting practices. Now, if there's anybody who knows the industry and the insides and how it works, it's Dave Willem. So I think without any kind of agenda against Lewis, but I think he's just interested in consumers being looked after carefully. That report got circulated, and we've now got into a spat where they've been reported to the National Credit Regulator for bypassing the rules and regulations. And in fact, today, they've just come out with a response, and quite an aggressive response indicating that they don't really think they've done anything wrong and that the business model is sustainable. So this is a business that's going to hog the headlines for a long time. But ultimately, the way I view it is they're selling two things, furniture and money. And they're putting it together, and the consumer, they're banking on consumer naivety. And that is not sustainable and can't last forever, and we think will result in lower margins going forward. In terms of selling furniture, there's other competitors coming out with much more compelling offers. You've got Steinhoff, who's now a global furniture giant, launching big box, much cheaper type brands and product. And as Sean's indicated, the other product that they're selling is money. And the price that they're charging for that money is off the chart compared to the same funding that people can get from elsewhere. So as the consumer becomes more sophisticated, they'll understand that to get the lounge suite, they don't need to buy Lewis's package, or they might still buy it. But ultimately, Lewis, we think, over time, will have to reduce the return that they get on that package because the consumer can go and get the lounge suite cheaper and the money cheaper.
Clearly, it means that their balance sheet can't cope with this. Has this always been the case, though?
I think it's very interesting to talk about their balance sheet because they're not structured like a lender. I mean, they're acting as the role of a credit lender, but they're not structured as such. If you look at and hence the low returns, despite them charging a 58% income yield on the total book, the advances book that they have, they're still only able to eke out a 15% return on equity, which is pretty subpar by South African standards and probably only just matching cost of equity, if that. And I think the reason for that is that it's inefficiently structured. So you've got a situation where we think the retail stores as a standalone must be loss-making without that credit offer. And secondly, they cannot gear their balance sheet because they probably don't have the willingness on the part of third-party funders to gear their book. So if you look at their debt to equity, it's about 1.3 times. So let's say the gearing is assets over equity is about 1.3 times. A typical bank would be 10 times. So and Capitec's probably 5 times. So they're somewhere in between.
Sure.
So it's really acting as a credit lender, but without the efficiency of their balance sheet to do so, and that limits their ability to achieve returns.
I know it's a bit difficult to tell, but are there certain telltale signs here that are similar to Able?
Well, I think so visibly the face of the income statement is still fairly healthy. But if you look at the industry over the course of the last 5 years, Ellerines basically went bankrupt, and the end result was Ellerines was effectively worth just about nothing. JD Group took billions of rands of write-offs, and Steinhoff had to come in and recapitalize the business significantly. So those are the major two competitors. Then you've got the third player, Lewis, who's kind of seemingly kind of immune to the kind of things that have happened to the stores either side of them. So it's quite difficult to reach kind of a firm conclusion and say, I guess a bit like African Bank 2 years before its demise, you looked at it and visibly things looked all right. Now, not for one moment do we have the ammunition to suggest that it's going to be an African bank, but what we can say with a fair amount of certainty is that the yield that they're getting off the customer seems very high, and that there must be quite a good chance that yield's got to come down. On top of that, you've got the credit life issue, where basically they're ensuring your outstanding balance on what you owe them, and it's a big issue with the regulator, where they're charging a significant amount of money for each 100 rand lent out. They're charging an amount of money where they're making significant margins off that. And the talk from the regulator is they're going to regulate how much you're allowed to charge. And that will have a significant negative impact on Lewis if it comes through the way that we think it will be. So I think what we really can say is that it's a business with a significant amount of risk in terms of sustainability of earnings and the regulations which might come its way.
And the debtors book also significantly underpriced.
Possibly a way of portraying the risk from an income statement point of view is if you said to yourself, let's assume that Lewis can make the same retail GP on selling of product that they make now, but take the yield in their debtors book down to the same level that Capitec can earn. If you did that exercise, their profits last year would have gone from 840 million to 100 million rand.
Sure.
So that gives you an idea of the sensitivity to lower yields. And I think the other point to make is that their sales, whilst their sales over the last 7 years have not actually kept up with inflation, the sale of furniture, the revenue growth from selling furniture has been behind inflation. Their book growth has been significantly stronger. Their book's more than doubled over that time period, which tells you that possibly there's a slight lengthening of the term taking place, which makes one question perhaps the cash generating ability of the business. And actually, if you look at the combination of cash flows out of this business, so that's cash in terms of cash generated, together with the payments that they've made of dividends, money to spend on capital expenditure for new stores, as well as the cash that's gone into the insurance entity, that cumulatively there's been about a 700 million rand shortfall over the last 7 years, which means that they have been gearing their book to effectively pay dividends to an extent.
Having said that, and looking at the furniture landscape just in total, you mentioned the competitive landscape and the pressures that they're also under. Could this be the opportune time for some kind of consolidation as well?
Well, you've seen a little bit of that, and that's largely because of Ellerines. So Ellerines basically auctioned off their assets. There was a lot less interest than people thought. But Lewis was able to pick up some nice assets out of that. So there will be a boost to Lewis out of a player being in the market being significantly smaller. So the consolidation was brought on by market conditions and Ellerines' inept performance. So in fact, I mean, the risk to everything that we're saying from a share price point of view is that Lewis actually produces some reasonable looking results. Because a lot of the stuff we're talking about doesn't necessarily come through in earnings in one particular year. And you've got the boost from Bears, which they bought from Ellerines. So I think, what you face in the next 6 months is the regulator and Lewis going to war with each other. But Lewis is responding to current regulations. And I think what you're also going to see is the regulator changing the rules. There's a high risk of that, in which case Lewis will have to change their business model. So and then of course their next audit, with the spotlight that's on them, the auditors are going to have to put a lot of thought into what provisions they require Lewis to put in their balance sheet against the debtors book, etc.
Well, having said that, let's take a look at what our experts think. Buy, hold or sell Lewis. Sean, buy, hold or sell Lewis as a stock?
Look, I think on the face of it, Lewis is very cheap. Trades at less than a 7 times P multiple, but I think the risks, the long-term risks to the earnings picture as the business model currently stand are unpalatable for me to bear. So I would say sell.
You agree, Peter?
Yeah, I mean, our thesis at Anchor Capital is based on buying good quality long-term growth shares. I don't think Lewis ticks any of those boxes. So we certainly wouldn't be a holder of the share.
What would it take for your view to change, for the risks to be mitigated maybe?
Possibly a much lower price, together with some kind of a restructuring of their business model such that we can buy into the manner in which they provide services to clients. So I think if there's a restructuring of the business and retail offering to the extent that their yields look similar to that of the competition and make them as competitive as that of the competition while still earning a reasonable return for shareholders, then that would possibly change our mind. I think that's quite a difficult thing to achieve in the short term though, and it's probably not going to happen without some kind of income statement impact.
Because they've clearly got a good management team. They managed to sell these products to customers at very high prices. So they're obviously doing something right in terms of the appeal to the customer. So one's got to give them that, but there's risk to the sustainability.
And diversification is also something that the competitors have done right with the likes of Steinhoff, I take it.
Sure.
Exactly. Well, we'll leave it there for this week's edition of Talking Stocks. Do join us again next time where we review another stock for you.
For the latest fundamental and technical analysis delivered right to your inbox, log on to talkingstocks.co.za and sign up for the Talking Stocks newsletter.